Hello, everyone. My name is Manoj Agrawal. I'm the group editor at Banking Frontiers magazine. I'm happy to invite all of you to today's conference, today's main session, the CEO panel discussion in our conference, NBFC's Tomorrow. We have a fantastic topic, a very straightforward yet fantastic topic, rethinking strategies for the new world. And me and my eminent panelists here are going to look at what is the future roadmap going to be like, what are the things to focus on, and see what kind of results can be expected from that. With that brief introduction about the topic, I would like to first invite all our panelists to briefly introduce yourself.
Thank you, Manoj. I am founder and chairman of Ugro Capital. After spending almost 25 years in financial services industry, I turned to entrepreneur and set up this business. It's a non-bank finance company. It's a combination of what we call knowledge and technology, and we are focused on building a small business financing platform in India. This is a segment of the market which is not well understood by mainline lenders, and that's why our aspiration is to build India's one of the largest small business financing platform. Where we try to solve this problem is our multi-pronged asset strategy approach and a very diversified liability approach. Our view is that in the future era, the non-bank finance company are those who would succeed and win market in being able to solve the problem are those who are very deeply focused on their segment or sector of the market and use deep technology and physical footprint and combination of the two to service their market.
Thank you, Manoj, and welcome all the co-panelists. I'm Sabyasachi Chira. I'm currently Executive Director and CEO for Karvi Financial Services Limited. I have around 26 years of experience, a mix of banks and non-banking finance company. I actually started 2 foreign banks in the country as the first CRO and have been in SME lending almost for 25 years. So currently in Karvi Financial Services Limited, we do micro lab, which is small ticket from 2 to 10 lakh loan against property. And what Mr. Nath said is that we are very focused on the segment what we want to do because most of the customers what we cater to are actually, I'll not say unbanked, they're banked, but they are unserved. They do not have a documented income proof with them. So we do use a lot of surrogate income proof and we do use a lot of technology to serve them.
I head iFinance, and iFinance is a NBFC that focuses on micro enterprises. These are the smallest of enterprises. Typical turnover is anywhere from 20 lakhs in a year to up to a crore in a year. So very, very small, just about 4 or 5 lakhs per month. And we have, in the last 7 years, offered loans to more than 200,000 of these micro enterprises. It's an exciting area to be in because many people feel that this is going to be a high risk area. There's going to be a lot of losses. And I think using good technology, good presence on the field, we have demonstrated that even in this segment, you can have a good portfolio with fairly smaller losses. And in doing so, create a social impact or create a socially positive impact in that market environment. Fantastic. Thank you. That kind of thinking really drives this triple bottom line thinking that is increasingly becoming people are becoming very conscious of that. So that's great. Thank you, Sanjay. Arun, please, let's have your introduction, please.
Thank you, Manoj, and good afternoon, everyone. My name is Arun Nayyar. I represent Neo Growth Credit. We are a SME-focused digital lending company. Fundamentally, what we are trying to do is we're trying to build a loan business around digital payments, and most of our client segments are consumer-facing retail customers who serve customers like restaurants, spa salon, pharmacies, grocers, and very happy to be part of this discussion today. Looking forward for a very good session.
Thank you, Manoj, and good afternoon, everyone. It's a pleasure to be speaking alongside you all. I am an ex-banker. I've spent about a decade working with different banks in the country, private sector as well as public sector banks, worked across all the aspects, operational aspects of banking and capital markets, and then really got excited about technology. So I've moved on to the technology side of it, really worked with the financial services sector in different geos, South Asia as well as overseas, Europe and APAC regions. At AWS, we have a lot of lending organizations as our customers, and I'm personally very excited about the work that some of the NBFCs and MFIs are doing in the country today, because as our governor keeps speaking, there is a huge scope for increasing the finance in the country, right? I mean, there are still many more people and businesses out there who need the finance. So happy to be speaking today.
When I used to interact with NBFCs earlier, 5 years ago, 7 years ago, NBFCs used to consider themselves as second cousins to the banks. They are the big brothers, they're up there. We are the small guys, we do this kind of work, and we kind of live under the umbrella of banks. But these days, it is completely different. That mindset has changed. I mean, NBFCs are so proud and focused and confident of what they're doing that they no longer seem this. And the recent example of, let's say, Ugro Capital tying up with Bank of Baroda, and I've seen 2-3 other similar news items. So I think NBFCs have, the leadership at NBFCs has a tremendous mindset change. And how did that happen is something I'm curious to know. And what is the result? What is the impact that the mindset change has created? Sanjay is smiling very wide, so maybe you want to start.
I can start, although I am not an NBFC veteran. Even I have been in banking almost 30 years, but let me just state that there was a time when NBFCs were talked of as non-banks, almost as if, and it was a derogatory term. So I was saying that I think ultimately it's becoming clear that whoever gives value to customers or adds value to customers is going to be the final winner. And whether you are a bank, you are an NBFC or whatever, ultimately, if you have a large customer base and you're giving value to the customer that the customer appreciates, then you have a very solid business that you're standing on, whether you use technology, whether you use people, whether you use different ways of sourcing funds. I think that's becoming more and more clear. And I think with technology now becoming a very important mix or a parameter in this mix, it's clear that the advantage that banks had in terms of having large pools of money and size is somewhere getting moderated. I think it's still a big advantage, but it is. I think that's why I think NBFCs are feeling good about it.
Okay, that's an interesting perspective. Sachin, would you like to put some other angle to this whole mindset thing?
Yes, so I don't know whether you call it change of the mindset or it is realization. So you have 3-4 kind of players when it comes to the credit dissemination industry. Private sector banks. In private sector, you have old generation private sector banks and new generation private sector banks. Public sector banks. So define banks as one category. Then you have NBFCs who want to or like to operate like banks, but failing continuously. I won't name anyone, but think of all large NBFCs owned by big corporates. And, they think because they are part of the large corporate world, they have power of the capital and they have ability to do everything exactly the same the bank does, but have constantly failed. And then the third is what I call the innovators, the problem solvers. What is changed is that now it is very well established that if you're not a bank, then your model has to be focused on something. If you're not solving a problem of a segment of the market, there is no value proposition available to you. And whether you are solving a problem through a gold loan, whether you are second-hand truck finance, whether you are solving a problem of a microcredit in a consumer underserved market, those who are deeply, because India's credit market the under penetration is so huge that you have a possibility of hundreds and hundreds of more financial institutions to get created. But the financial institution, those who are in business of replication would fail, but those who are in the business of innovation would succeed. So that's, I would say that.
That's a very valid and very meaningful observation. Yeah, yes. So looking to the near future, now and in the near future, what are some of the constraints do you see either for the organization, for the sector as a whole, or for your own organization that you think you should overcome? Is it people? Is it technology? Is it, I don't know, something else, partnerships, whatever?
I can go first, Manoj, if you want. I think so. Look, the people and technology constraint are not really the constraint. It is our ability to keep enhancing that. I think so for financial services industry, especially for lending, it is a constraint of mindset. And on one spectrum, which we call the liability side spectrum. See, unlike West, in India, for lending institutions who are not raising deposit from public, the liability is predominantly come from same set of banks, which you can call traditional or new generation banks, and you're then dependent upon some form of rating and others. And India is a country which I told you when we met that India is a country wherein Saraswati Lakshmi don't sit together. If you are blessed with Saraswati, you are expected to ask Diksha. Now, because everyone go to the Lakshmi Pati. The way I say it is that the entire liability spectrum rating agency is overweighted to these large names and large rated companies. And those ratings are not because of this solid underlying business model. It is because of some name associated with that. And that actually constantly hamper, and most of the people present here would say that constantly hamper your ability to innovate and grow and serve the market. Because when you have to be compared to somebody who is a AAA company, not because of its underlying business model, because it's a name associated, versus a company which is being built by people like us or Sanjay, or Arun, everyone else, then you feel suffocated because that you are doing good, you are building it nice, there is no problem with the business, but you are being arbitrarily differentiated. So that's a big constraint. But the way I think about it is that in India in last 2 decades, multiple financial institutions, especially starting from microfinance and converting to SFBs, have overcome this problem. One has to have patience and pass the first 3 or 4 years, and after that it opens up and you are at par, with everyone else.
Okay, so there's no instant fix, but there is a solution, and the solution is in the mind. So that's good. That's good. Who else would like to share some other theory constraint that you're tackling?
So Manoj, yeah. So I completely endorse Mr. Naz's view. So if you look at the current set of liabilities, what the NBFCs actually get, in fact, if you look at the pre-ILFS, it was basically asset side problem for NBFCs. Okay, so it was actually a lot of competitive environment. You used to get asset, you had to really compete. The focus had shifted post ILFS to a liability side management. What is very critical for NBFCs now is basically liability side, because one of the biggest tap which used to fund NBFCs was mutual fund, which have stopped funding to NBFCs. So they are only now funding to the rated NBFCs. Now the second is on the banks. So if you look at the banks, all of them, they are almost full on the cap. So RBI has a cap that the banks can lend 15% of their net worth to NBFCs. Most of them are full on their cap, and they do not want to get into a lesser rated NBFC. So they only want to get into a AA plus rated NBFC. So mostly you'll find that both these taps have actually dried up, and the NBFCs have stopped getting funding. Yeah. So in fact, if you approach any of the PSU bank, and the problem becomes much more critical if you are a small or a mid-size NBFC with a rating of external rating of BBB or maybe a little lesser than A, so which is an investment grade NBFC, then the problem becomes much more magnified. So liability is the biggest challenge. On top of that, as COVID has actually stuck us, so you'll find that the collection efficiencies have dipped significantly for NBFC. Of course, we are now seeing a good amount of recovery happening in at least last 2 months. But if you look at the collection efficiency, which was as low as 30% in last year, April and May, has
Mhm.
come back, at least in our segment, to around 80-85% at this point of time. So your cash flows, because of the COVID and also the funding not being available, are restricted. So that is where I see the biggest challenge for NBFC. I think people, technology are challenges which are absolutely you will be able to, as a CEO, I'll be able to manage. So there are so many options available.
So hopefully COVID will pass. But as far as funding, let's see then. Anyone else has a challenge or a solution they want to talk about?
I was, when I look at the real constraints, maybe because we are not still the 2 crore rupee NBFC or book NBFC, we're still mid-sized NBFCs. I think the funding is not really looking like a big constraint. I think there's a reasonable amount of money available, and
Okay.
it can fund our growth. Even if you want to grow at 100%, even 100, 200% growth, we can get that funded. So realistically for us and for many mid-size NBFCs, funding is not really a constraint as of now. Maybe it will become a constraint when we become very large.
Okay.
But I think the big one is maintaining a good and an agile team, because I think the markets move very quickly. And one of the things that NBFCs have done well is to take up opportunities that emerge and be agile. And for that, you need a good team who can look at opportunities, who can leverage those opportunities and go in areas where others have never bothered to go in. So I think that's the difference in the DNA that NBFCs have as compared to large established banks. The other thing that I feel is that I think in a way, the ability to continue to improve your credit or underwriting skill, especially in marginalized customers. And when I say marginalized, I take it in a larger context, because NBFCs typically have been catering to customers that in banks' view are marginal. And we have a huge Pareto lying that there's a very few, 10% of the customers are with the banks, and they control a substantial amount of net worth of the banking system. But there's a 90% plus which is left out, and NBFCs have always done well in capturing this marginalized customer, if I may call that. And I think ability to underwrite it well is a constraint, because if you don't do that, you can get wiped out very quickly. It's not a very structured market. It's not someone who has been rated by the credit bureau or to lend. So lending is difficult, but NBFCs have normally overcome these constraints well, and different people have different models. We use a cluster-based model. Arun uses a different model. Sachi uses a different model. Sabyasachi uses a different model, and I'm sure that in AWS, Nehal uses a separate model. Each one has a solidity of that model, and I think that is, if you don't have that, that can be a huge constraint in this market.
Nehal, you've heard this gentleman. What is your take on, and since you said AWS works with a lot of NBFCs and lenders, what do you see as the upcoming constraints? And is Amazon geared up to do something about it?
Sure. I think couple of, not talking technology here, but couple of constraints that I personally have observed by working with a lot of these customers is that I think the end customers, even though they may not have credit scores or they may be from the marginalized segment, are moving forward, and they are also demanding finance, right? And they are demanding finance, in a way that they can consume it, when they consume it, etc. So I think one constraint which I observed with some of the not the digital lenders of the who are recent startups, not those, but traditional NBFCs especially, I've noticed they are not able to really move with the customers' demands. And I feel it's important to know what your customers want, first of all, and then really look at empowering our employees. So in my observations and discussions with customers who are in the lending business so far, I have found that customers are looking for solutions that are not targeted at any one aspect. If they're targeted, they need to be targeted at both the employees as well as the end customers. the consumers or the SME businesses, because only when you bring both of these together and make life simpler for both of them will you really be able to overcome the bigger aspects like growth or things like that. So I think understanding the customer and moving with the customer's expectations is something that NBFCs need to really adopt big time. That's what I personally think.
All the major successful companies have deployed tools and technologies and models to really understand the customer for whatever solution, whether it is Zomato, whether it is Amazon, whether it is Uber, whether it is, it's all driven around customer insights and customer.
Yeah, we have a leadership principle of customer obsession, and we live and breathe that every single day. We have that. So I think it's very important to understand where your customers or prospects are going, what are their needs, and then working backwards from there.
Fantastic.
I think that's a constraint.
I like that word, obsession. Obsession sounds so powerful. Let's jump to another issue, and I'm going to start with an analogy. In food, we have two kinds of food. We have snacks and we have full meals. And traditionally, it has always been full meals that have been said to be healthy, and snacks have been not so healthy. But these days, for many of us, if not all of us, snacking has increased and regular meals have kind of come down. I'm seeing a similar trend in business also, in the sense we are consuming technology like snacks, very small bites, quick bites, 3-month projects. Whereas business strategy is required to be long-term, maybe a 5-year vision, maybe an entrepreneur's vision for 20 years kind of thing, So how do we get and given the fact that IT is playing a bigger and bigger role in the whole thing, becoming a bigger component of the whole strategy, how do you find that balance between snacking and a wholesome meal in terms of technology and business? That's something I'd be really interested to know. And I've never got a good answer for this so far. So let's see what I get today. Yes, Arun.
From NBFC standpoint, it's essentially using technology across the value chain, right from the customer acquisition till you collect the money. And what our experience has been that you can create a modular system of digitizing each and every element of the value chain. Typically, organizations start with the front end first. How do you connect with the customer digitally? How do you onboard them digitally? Or there are organizations who have strong digital presence around underwriting models, scorecards, selection segmentation. So my view is that you need to have a bigger picture, the picture of the entire value chain, but approach it in a modular fashion, and that really helps you respond to the market needs a lot more quickly.
Okay, Arun, that's good. So you're saying break down the big thing into smaller bites and consume them.
Manoj, I think that the difference between the snack and the main meal has reduced or merged. You have on one side technology firms that are becoming lenders, and the lenders are moving towards technology. So I think you'll find that differentiation, that gray area is very fast getting merged into mainstream. So that's why you'll find that it's not that we use technology as a flavor to add to our financial offering. Technology itself has become the point of competition. You have lots of technology-related companies which are, when you ask them that what is your model for making profits, they say in the end we will start lending, or we'll find a bank or an NBFC to lend to. So the monetization model has become lending, and there are lots of lenders who have become so good at technology that they can give a good technology firm a run for its money. So I think that the differentiations are merging, and very soon you'll have to.
So you're saying that reminds me that you're saying that like healthy snacks are coming. It's not just chips and chocolates, but there are some healthy, whatever. I don't know what to name, but that option is there. So that's good. That's good. So nice perspectives coming. Nehal, do you see some kind of models that bridge business strategy and technology strategy at the, how CEOs should look at it?
Absolutely. So I think I like the analogy that Chachendra gave. So in AWS, we call it being a data-driven enterprise, right? So you need snacks and you need full meals. Both of them are needed. And essentially the way we work is that, you need to ensure that you are aligning the technology or the snack or the meal with the business goals. So it's important to have that alignment. For example, today I could just have an aspiration that I am doing only microfinance. Now I want to get into other finances like a housing finance or other kind of things. I want to move out of rural areas, villages, and go to urban poor, right? If you have that as an aspiration, then you need to have a snack which is targeted towards that business goal. But essentially, the underpinning theme of being technology driven or having that full meal is to be a data driven enterprise where you are actually leveraging all possible data. What you have, what you don't have, what you're trying to get, what your partners have, and churning out, making actionable decisions based on that, which, as I said, and I agree with Chachendra, it is an enabler for business. But the core element of enabling is the data, right? So, and you can do a whole lot of things when you are a data-driven enterprise. And those are the organizations that give tech firms a run for their money. So I think it's very important to institutionalize knowledge that your employees, human beings have today, so that they also get back something out of that institutionalization.
I'd like to move ahead, and maybe I'll start with Sabyasachi. I want to touch upon kind of a very uncommon area, which is this. We all use social media extensively, right? From a 3-year-old kid till a 90-year-old, whatever you are. But as leaders, how do you see leaders using social media in any particular way? Either you yourself do, or is there someone that you know who's using social media effectively, not just for entertainment, but in a meaningful way as a leader? Any examples anyone can share?
No, Manoj, you're right. Social media, I think, plays a very critical role in our life. But it also depends on what evolution cycle as a NBFC you are, and what is the customer segment what you are looking at. Like what Sanjay said, that the customer segment what you are looking at, they're mostly unserved, yeah, and they do not use social media as much as the other customers will. In fact, we recently did a study because we wanted to start a digital marketing initiative. We actually found out that only 70% of our customers are using Facebook in some form, but they will not be available on a LinkedIn or on a Twitter, right? My customer segment is somebody who is a micro enterprises. So they do not use social media. So as a CEO of my organization, I definitely need to use social media. Yeah, that is very good for me to get across to the private equity investor, to my lending communities. Yes, but for my customer footprint, for my customer presence, it will all depend on my customer segment. So for me, the customer segment I am into, the social media doesn't play a very powerful role. But for me, for the presence of my model, for the MSME, and also to get across to the lenders, to get across to the private equity community, I think social media plays a very powerful role. The other part also is that, as you know, RBI and many of the banks are now encouraging for co-lending or a BC model. So that is where the footprint in the social media also plays a major role. So the more and more I am visible on the social media and the world gets to know that one kind of co-lending or what kind of product I can offer, which is the segment what I'm getting into, or what kind of technology superiority I have, then it becomes much easier for you to connect with the other players in the market and look for similar opportunities where the synergies are available.
That's great. Two very good examples. Investors and the broader partners and all that. Any other examples of using social media in an intelligent way?
I can say so I will talk about me as an individual and Ugro as a company, and how do we use social media and its relevance and importance. Our view is that there is a virtual footprint of almost everyone in some form and shape in the country, and social media is very, very powerful. You need to know and use it effectively to your benefit and for the community. If you look at me as an individual, I have certain platform which I keep it only for professional networking and certain platform which I only use for family. For example, my Facebook, I would have nobody ever connected with me who's not my friend or relative. So that's a very clear definition. And on my LinkedIn, I have 33,000 plus people, right? So that's the way I divide the world. And I have seen, especially in pandemic, that the number of networks and the people connect which I was able to create in last 1.5 years, I have not done that in last 10 years or so. So it is as powerful as it is. Right?
Yes.
Second, as a company, I think so we are not yet reached the level of maturity because when it comes to social media, generally it is very expensive proposition. So reason why Facebook is valued where it is valued, why all social media companies is that because the underlying cost of reaching out to your targeted customer through any social media platform is prohibitively expensive and it doesn't make sense. So you have to get to figure out what is the best method to be present and engage with people. And we are still soul searching on that and we have not come across a good solution for that.
Interesting. Okay. So that's a bottleneck that has to be tackled in the future.
Yeah, our size would take care of that. Once we have more disposable income in hand at the level of the company, we should start doing that very effectively.
Yeah, so that makes sense. Anyone else?
I feel in fact mirror what Sabyasachi said, that for us to reach our customers, social media is probably not the most appropriate channel. Because they are from the unorganized sector and probably do not have that much of a digital presence. But we have two stakeholders, one, the investors or the debt providers who can be reached, and our employees. These are two sections that are quite reachable with social media, and a lot of effort should be put onto that. What we do is that on the employee side, we have a lot of platforms of engaging, and it could be through the HRMS product, through the WhatsApp product, through even Facebook events, etc. So there's a lot of activity that happens on at employee level, and it is more to create the engagement and fun. Less so in learning, although we have digital learning platforms also, but social media for getting that engagement.
Okay.
On the investor side, we use professional channels like the LinkedIn. We have almost 50,000 odd LinkedIn followers for our company. And that brings in all the investors, the debt providers, even people who are professionals and who are looking for an opening in the company. That is the channel we use. So one has to choose the mode through which you reach out in the social media.
So I think that kind of summarizes overall between the three of you what the social media space looks like. Let's come to our final point. We're running out of time. Arun, can we come to our final point?
Yeah,
this is
please.
a very interesting point. It's a very interesting words of wisdom. I think Warren Buffett said this, that culture eats strategy for lunch. Or in simpler words, culture is much more powerful than strategy as a tool, as an organizational tool. So a question to each of you is, what is that one cultural objective that you have for the next 1 or 3 or 5 years that you'd like to build in your organization as a leader? That will, two things that will obviously make a difference to the organization, but hopefully it will also leave a footprint about, yes, this is the culture that you introduced.
I think I would say ownership, the sense of ownership is very, very critical.
Okay. Ownership among the people, about ownership of the organization. Okay, that's interesting. Some bonding kind of with the organization as such.
Yeah, being responsible, being an owner of, thinking like an owner rather than an employee.
Thinking like an owner. Okay. Fair enough. That's great. Yeah.
So
That's a challenge because people want to be more and more disengaged in general. So that's going uphill. Yes, Sabyasachi.
Yeah, Manoj, for me, I think an emotional leader is something which is the call of the day. And especially COVID actually has taught us to be an emotional leader. Yeah, so I'll actually talk about small things. So maybe 3 years prior to COVID, nobody would have thought that you actually need to track your employees and their families very closely. So in my financial organization, I have 150 employees. So every day I get a report that who are the guys who have got a vaccine, who are the guys who have not got a vaccine, who are the people who are affected with COVID, their family was affected. We did a well-being session for 5 days where the first day was a doctor came on the call and explained everything about COVID. Then we had 2 days yoga, 1 day mental well-being. So I think emotional leader is something which is very critical. In fact, we also decided we will have a mass vaccination where the company did bear the entire staff vaccination. So I think it's now much more blurred because all of us spend so much of time in our office or with our colleagues that they have become absolutely a part of your extended family. And COVID has actually made you come closer. So that means that as a leader, you have to be very, very empathetic towards their need also, apart from the work need or the work culture. So it is, I'll say that it's an empathetic culture which needs to develop in an organization.
Fantastic. So empathy and emotion both are now part of professionalism.
Yes.
I think the new definition of professionalism will, yeah, superb.
Well said.
Who wants to go next?
I think from my perspective, where I stand, it's very important that the divide between the business and the technology teams within an organization is dissolved completely. I feel organizations where business gives requirements to technology and works out BRDs and then technology scrambles together, I think that should be passé for everybody. They should work together as a team because, when financial services institutions want to become technology organizations and technology organizations want to get into finance, whatever you are, whether you're an NBFC or a microfinance institutions, you can really achieve greater heights if both these sets of people are, completely aligned with each other, understand each other, and work with each other towards a common vision. I think that's very important.
I'll just add to that something I read recently. The government of India is trying to bring more integration between Army, Navy, and Air Force. Even these huge organizations, even they have these silos, even though they're fighting a common enemy, but still there are these silos and it's tough. So I think
that's why they came up with a CDS, right? So
correct, exactly.
is the CDS. That's the reason for which they wanted to integrate all three of them.
Yeah, but we can see the trickle-down effects within an organization. Great. Sanjay, would like to hear from you.
Manoj, even I completely agree that culture is extremely crucial if you want to create an institution and not a small business. And it's like a cement, in a building, the purpose of cement, it really makes the building solid. And I think culture is to a large extent sharing of a dream or a vision. I think Nehal touched upon that if people share that vision, and they have a common value system, then that is what exactly the culture of the organization is. And if you have a solid dream that you are going behind, everyone feels energized about that dream. And we know that the method that we are following or the values that we are using are the right values. It can really lift the team, and the sum of 1 and 1 can be a lot more than 2. So I think it's a synergy that works. And not only the synergy that helps the business, but it creates happiness in the organization. So organizations which have good culture are happy organizations where people want to wake up in the morning and come to office.
Makes sense. Absolutely.
Many things. There has to be ownership, as Arun mentioned. There has to be transparency. There has to be excitement around achieving something. So it doesn't mean that you should have low achievement.
But Sanjay, any one thing as a cultural goal do you have, if not now, near future?
See, I would go to what Sabyasachi mentioned, that it is people orientation that is important, and probably the emotions of the team is where I think you should focus your attention.
Okay, that's good. So 2 votes for emotion. Sachin, what would you say?
So I'm burdened with being the last word. So, culture is important. And I'm only driving one culture, is culture of unlearning. one of the biggest problem in financial services industry is that we are all overweighted to bring on people who are very experienced. And, because we believe that it's a business of credit and it's a business of knowledge and intellect. So we should bring people who are very well experienced. But actually that is the bottleneck, because the learning of past is not relevant for today. So I'm driving this culture that if you come, your learning is good, but first unlearn what you have learned so that you can innovate here. So, and that's very, very hard. This required some hard calls, change people, change management, because you would come across in financial services, and I hope most of people who turn to entrepreneur would agree that people come with very defined thought process. ये ऐसे ही होता है, हमने ऐसे ही किया है, ऐसे ही किया जाता है, नहीं इसमें कुछ चेंज नहीं कर सकते हैं, इसमें रिस्क ज्यादा है, ऐसा आपको पता नहीं है, आपको समझ नहीं आता है. And that's what I say, please unlearn what you have learned for so many years. Then you start fresh, and then what you have learned in the past will start benefiting you.
You are right, and this unlearning begins at home. When older people like us ask our kids, how do I do this? How do I do that? At that time, we realize that all that massive knowledge that we think we have acquired is still insufficient for dealing with many small things in the new world that we are in. So yes, unlearning, emotions, empathy, vision, values, innovation. I think these are all fantastic cultural objectives. They really bind the organization and they strengthen it. They bind the people and they strengthen the organization to create an institution, which is what so many people desire to make. So from my side, that's been a fantastic discussion. Thank you all. Thank you very much for being a part
Thank you
of
very much.
Thank
Pleasure
you.
meeting with you all.
Panel
Bye-bye.
Thanks, everyone. Thanks.